Hello everybody, I hope you are doing well. So this is the first and the only video for chapter 5 of the Introduction to Quantitative Finance course. So the objectives of this chapter is first to describe the CAPM model, which is a model attempting to determine the expected return of some security, of some asset, in terms of its covariance with the market portfolio, which we've identified in the previous chapter. So basically, it's a model to determine what should be the expected return of an asset given its characteristics, and the CAPM is derived from the theory, mean variance portfolio optimization theory we've studied in the previous chapter. And then by the end of the chapter, we're going to briefly discuss some shortfalls of the CAPM model and propose extensions to the model through what we call factor models. So we're going to study CAPM models and then extend it to factor models. So recall from chapter 4 that we define some portfolio called the market portfolio. And here M will be the weights of the market portfolio. So recall, let's do a quick reminder here. So here, this was the minimum variance line. Here, this is sigma and mu. So here in this hyperbola was the set of all admissible portfolios containing only risky assets. And then if you had the following, so let's say there's the risk-free rate here. So we could draw a tangent line here which was touching on, so the drawing is not perfectly drawn here, but here assume that this point only touches in one point here, and this point was what we call the market portfolio. So the market portfolio is the only portfolio which is fully invested in risky assets because it's on this line here, but which is also optimal when we include the risk-free asset. Okay, so this was the market portfolio we studied in the previous section, and we're going to denote by boldface M the vector of its weights. Okay, so in the previous chapter we used W for weights, but for this particular portfolio we're going to use M, where M stands for market portfolio. Okay, so M is the weight of this market portfolio. Mu M and sigma square M are defined as respectively the expected return of the market portfolio and the variance of the return of this market portfolio. And one quick note here to ensure that this portfolio exists, we had to make the following assumption, which was that the risk-free rate was smaller than here, this point here. So this is the expected return of the minimum variance portfolio. So the minimum variance portfolio is the portfolio, maybe I'll draw it here, the portfolio just at the tip of the hyperbola. So its expected return had to be greater than the risk-free rate if we wanted some tangent line here to exist. Okay, so we have the market portfolio whose weights are denoted by M, and its expected return and variance of return are respectively mu M and sigma square M. So we're going to see a conclusion from the theory outlined in the previous chapter that is a bit surprising but very useful. So the CAPM model relies on the following formula. For any portfolio W, we have the following relationship. So for any portfolio W, it's excess return, which is the expected return of the portfolio W minus the risk-free rate, must be equal to beta, some value beta, which depends on the portfolio, times the excess return on the market portfolio. Okay, where here beta, we're going to see that it's given by the covariance between the return of the market portfolio and of the portfolio return, portfolio W return, divided by the variance of the return on the market portfolio. Okay, so this relationship here is the CAPM model. It relates the excess return of a portfolio to both the excess return on the market portfolio and the relationship or covariance between the portfolio W and the market portfolio. So let's prove this result now. Okay, so but before before proving this, why is it useful? It's because the CAPM relationship allows investors or market participants to estimate the return on some security. Okay, so if you have a given stock, then you can look at its historical covariance, the covariance of its return with the market portfolio, and then once you have this quantity, you can calculate what we call the beta of the firm or the security, and then from this relationship you can plug this beta here, which you obtain from market historical data, and this leads you to this relationship. Okay, so it says that the expected return of the security should be driven by this relationship. Okay, so we mentioned in previous chapters that if you want to estimate mu from purely a statistical analysis, sometimes values for mu, the expected return, are unstable statistically. So in practice, some financial institutions, instead of using statistical methods to estimate mu, they use statistical methods to estimate the beta here, and then they use this relationship to determine the mean, like mu W, the expected return for a security in terms of this quantity. And this quantity, often people deem it more stable statistically, so the covariance more statistically stable than the expected return. Okay, and here you might say, well, if you want to use this, you still need a value for mu m. Well, mu m, there are some like economics models that can predict, for example, the growth for broad market indices or something like that. So this, of course, you can extract it from statistical methods, but you have also a whole plethora of other economic models to determine this value. Okay, so we see that CAPM is very useful because it allows estimating, if you believe in that model, of course, but if you believe in that model, it allows you to get a value for the expected return of a security based on what we call the beta of the firm, and the beta of the firm, which is based on the covariance between its historical returns and returns of the market portfolio, can be extracted statistically. So why? Well, for investors, it's very important to have the expected return of a firm, but even if you're in the management of that firm, it's also very relevant to have this information because it allows estimating what we call the cost of capital in the firm. Okay, so what's the cost of capital? Let's say the firm issues stocks, so they have to have an estimate of how much investors will expect to make as profits on their stocks that they issued. So investors will of course purchase the stocks, but they will be expecting profits so as to match profitability targets. And such targets, they can be estimated in practice using the expected return on the security, which can be provided by CAPM. Okay, so this is why these models which predict the expected return of a security or the cost of capital in a firm are very important. Note that a quick note: cost of capital, it's made both of because when you issue capital, you might issue both equity or bonds. So the cost of capital is some blending of the expected return on the stocks of the company and the expected return on the debt, which are the interest rate on the debt. Okay, but still, you need to quantify the cost of capital. You need to have an idea of what should be the expected returns on stocks of the firm. So now we will prove the CAPM relationship. Okay, so let's recall the formula for the weights of the market portfolio. So we remember from chapter 4 that the market portfolio has zero investment in the risk-free asset because it lies exactly on the minimal variance line. So it's fully invested in risky assets, and its weights are given according to the following formula, which we derived in chapter 4. So the weights were given by 1 over gamma times the inverse of the covariance matrix of assets in the market times the expected return vector for all assets minus a vector which contains only r's. Okay, so r times the vector of 1 is a column vector which contains r. Okay, and gamma, it's again the same quantity, but we multiply this quantity by a row vector of 1. So here the denominator here becomes a 1 by 1 quantity. It becomes a scalar. Okay, so this is nothing new. It's the weights for the market portfolio we derived in the previous chapter. And once again, don't be afraid to pause the video and have a notepad or like a sheet of paper to derive formulas as we go and make sure you're following all the steps. Okay, so now for any portfolio W, so W doesn't need to be some form of optimal portfolio or something like that. It's any portfolio. We have the following relationship. So the covariance between the return of the market portfolio and the return of the portfolio W, it's expressed as the following. So it's the covariance. So this is the return of the market portfolio, the sum of weights on each asset for the market portfolio. Okay, so recall M are the weights of the market portfolio times the return of each asset, because recall that the weight of a portfolio is simply the weighted sum of returns on each assets. And so this is the return of the market portfolio, and we can do the same thing for the portfolio W. So the return of the portfolio W is simply a weighted average of returns on each market asset. So here the sums and the coefficients M and W, they can be taken out of the covariance because all these are constants, and the covariance is a linear function of both its arguments. Okay, so we can take out the sums and the constants outside of the covariance, and this becomes the covariance between Ki and Kj, the ith asset and jth asset. Okay, so this is Cij, it's the element in row I and column J of the covariance matrix. And here this is a quadratic form, so if you go back to the math primer slides, then you can see that these kind of quadratic forms, they can be expressed vectorially through the following equation. Okay, so we had something in the primer slides. I don't recall the notation we used, but we had something like A, B, C. So let's say A, B, and C. A and C are column vector and B is a matrix. Then you have something like sum over I's and J's of A, I, C, J, B, I, and j. Okay, so if you apply this formula to this equation here, you can replace the bij's by, in fact, the covariance is Cij, replace the a's and the c's by the m's and the w's, so we have the following quadratic form. This is W transpose C times M. Okay, so we have an expression for the covariance of the market portfolio return and the portfolio return of any portfolio W. It's given by this expression here. So W transpose CM. I'll just revert back to red. Okay. So this implies that the beta, the quantity beta we considered earlier, we defined it. So this is a definition. It's not something we prove. We define beta as the following quantity, as the covariance between the market portfolio and the return of the portfolio W divided by the variance of the return of the market portfolio. Okay, so here this denominator, it's equal to covariance between Km and Km. So because of that, we can simply set, okay, so at the numerator here, this is what we just shown in the previous slide. The covariance between market portfolio and any portfolio W is W transpose Cm. But here what we can do, we can simply let W is equal to M. So if we have let W is equal to M, then the denominator here becomes equal to M transpose Cm. Okay, so this beta W here, defined as the covariance between the market portfolio and the portfolio W returns divided by the variance of the market portfolio returns, is given by this expression. Okay. But now, recall that we have an expression for the weights of the market portfolio. So from the previous slide, we had that the market portfolio was of the following form. It was some constant here times the inverse of C times mu minus a vector of R's. So we can substitute here both M's here on the right side of C by this quantity. So if we do that, we can just plug this expression and replace this M and this M here. So then we would get the following expression here. And once we have that, then we can see that some terms cancel out. So for example, the 1 over gammas, they cancel out with each other because they are constants. Okay, so we can take them in front of the product, cancel them out. CC inverse, it becomes identity, so it disappears. CC inverse, same thing. So once we cancel out all these terms, then we have the following expression. Okay, and here recall that here this must be equal to 1 because the weight of any portfolio must sum to 1, and because the market portfolio is some portfolio, its weight must also sum to 1. So if we apply these two equalities, in what follows, we have that this guy is equal to, so this is the expected return on the portfolio W minus here, this is R times W transpose 1, so it's simply R. And here at the denominator, we have the same thing, but this mu here is the expected return of the market portfolio. And once we have that, well, we're done. Okay, recall what we were trying to show. We were trying to show that this numerator here, the excess return of the of a portfolio W, is equal to its beta, defined as this, times the excess return on the market portfolio. Okay, so this completes the proof. So the proof is not super complicated, but the results is surprising, is that given for some portfolio, you don't need other information than its covariance with the market portfolio to predict its expected return. Okay, so this is very surprising, but this would be a consequence of the mean variance portfolio optimization theory if you believe that theory. Okay, so in practice, of course, um, okay, well, let's talk about that right now. In practice, is this a suitable hypothesis? Okay, so mean variance portfolio optimization, is it something realistic that to consider in practice? Okay, so it was shown by several empirical studies that the expected return of some security, because recall a single security is an example of a portfolio with only one share. Okay, so the CAPM model, yes, it applies to portfolios, but as particular cases, it applies to individual securities or individual stocks. So empirical studies have shown that the CAPM model did not perfectly fit to empirical data, empirical stock return data. Okay, so it seemed that there are other factors or other quantities which were also characterizing the returns on the stock other than its covariance with the market portfolio return. So this, okay, we have a nice theory, the CAPM, but we try it on some data, or some people have tried it to apply this on some data, and they've seen or identified shortfalls about this theory. Okay, so this suggests that we might want to extend the CAPM to also include the impact of these other risk factors on the expected return of a security or a portfolio. So the extension to the CAPM that was proposed in the literature, so of course there are many types of extension, but one possible extension of the CAPM model is referred to as factor models. So in factor models, the structure of the model is set up as follows. Okay, so of course there are many ways to formulate factor models, but this is let's say a standard or conventional way of defining a factor model. So here in the factor model, the typical assumption is the following. It's that the expected return, the return on a security KJ. Okay, so this is the return on security KJ. So this is the excess return on that security J is equal to here AJ. So this is a constant which depends on the security plus a linear combination, so a sum across capital L factors of, this is the BJL, it's a constant, again, it's the coefficient associated with security J and factor L times a random factor L, plus here it's a noise term, epsilon J, which is idiosyncratic to the security. Okay, so this for each security, the noise term will be different. Okay, so all these constants, A's and B's, they are idiosyncratic to the various securities or assets. So if you have two different stocks, its associated A's and B's will be different. But conversely, the F's, which are the factors, they're common across all securities. Okay, so the factors are random variables, but the A's and the B's are deterministic or constant values, which are referred to as either A is referred to as the intercept and B is referred to as the factor loadings. Okay, and finally, the noise term epsilon, it's meant to represent for the fact that if there were no epsilon, this relationship would not be perfect. Okay, so if you consider this relationship, you want to have perfect match with your data, so you add some noise term to represent the discrepancy between what your model proposes and what you observe. Okay, so this is a noise term, and this noise will be different across all securities. So these factor models, they were made popular, for instance, by the seminal paper of Ross, 1976, which where this kind of theory with factor models was referred to as arbitrage pricing theory. Okay, so here it's different. This is arbitrage pricing theory, and what we did in previous chapters is often referred to no arbitrage pricing. Okay, so the name looks the same, but it refers really to two different theories. Okay, so to represent the expected return of securities, this is arbitrage pricing theory, whereas for the pricing of derivatives in earlier chapters, it's often referred to as no arbitrage derivatives pricing or something like that. Okay, so what's the rationale here about these types of formulas? These entails that the set of returns across all securities are driven by some few common factors. Okay, so typically J it represents the securities, but there are many securities in practice. Whereas capital L here, it's the number of factors, and typically in models, the number of factors is somewhat small. So let's say 3, 4, 5, or something like that. Okay, so the idea here is that using these models, assume that the set of returns for all securities are mainly driven by a few common factors. So why this is the case? Well, it makes sense to think that some outcomes have an influence not over single stocks at the time, but across many stocks. So if there's a financial crisis, it's not only one stock that plunges all the time, but all stocks tend to go down together. So it shows that there are common movements across stocks, and so you can use one single factor in that case to represent a market crash. So once this factor crashes, then if all factors are linearly related to that factor, then all stocks would crash at the same time. Okay, so the idea here is to assume that there are a few driving forces which impact all stocks simultaneously, and then can explain their return. Okay, so the first paragraph is what I just explained. Moreover, one assumption about this model is that the relationship between returns of the various securities and the factors is linear. Okay, so is this a good thing? Well, for statistical purpose, it's very useful, because if you go back here on one slide, these types of models where we have to estimate in practice the A's and the B's, which are unknown, these are linear models, so we can use linear regression methods to estimate the constants A's and B's. Okay, so for those who did their linear regression class, you know this theory, you know that these type of models can be estimated through linear regression. But if you haven't done linear regression, please just I just want to tell you that there are statistical methods to estimate the constant A's and B's from historical data in that case. Okay, and so this is what we said. The factors are common forces driving the returns of the various assets at the same time, so some form of systemic effects across all securities. But because each individual firm might also have a portion of their return which is not explainable by these common driving forces, but they are only specific to the given firm. So let's say some given firm does a like special action, it's not going to impact the return of all the firms. So this noise term epsilon j is meant to represent that portion of the return or the risk which is idiosyncratic to a given firm j. So we can see that, like, if we go back here, the returns of the set of all firms is driven by so this term, which is impacted by the randomness common to all stocks. So this is kind of the systemic part of the risk for a stock. And this here, the epsilon, the noise term, is the idiosyncratic part, which is not influenced by the main driving force. Okay, so for that reason, we assume typically that the noise term epsilon here is uncorrelated with the other factors. So either uncorrelated, or sometimes people assume independence. So we assume that the factors here do not impact the noise term epsilon and vice versa. Okay, so is the CAPM model a particular case of these factor models? The answer is yes. Okay, so we can see that factor models are a generalization of CAPM. So how can we see that? Well, if we set first capital M is equal, capital L, is equal to 1, if we have a single factor, then, and moreover, we make the following choices. So let's say the intercept term A is equal exactly to 0, and the loading constant for the first factor, we can set it to the beta of the firm, which is the covariance between Km, return of the jth firm and the market portfolio divided by the variance of the market portfolio return. Then we see that using these equalities lead to the CAPM model. We revert back to the CAPM model by using this. Okay, so let's illustrate that. So if we go back two slides. So let's say that we said capital L is equal to 1, then AJ is equal to 0, then we can set beta J, BJ1 is equal to beta J, and then we can make, so here the factor L, so here L must be exactly 1 because there's only factor. This will be equal to the return of the market portfolio minus its expected return. Okay, so if we plug all this, then we obtain the following relationship. It's that the excess return on the jth firm, for the jth firm, so this is equal to 0. This is equal to B1F1, so BJ1F1, so this is the beta of the firm. So this is the B times F1, it's equal to Km minus, this should not be mu M, this should be R. I made a mistake here. So if we do that, this is R plus epsilon J. So if we make these choices, we obtain this. So if we take the expectation on both sides, we have something like this is equal to something like this. Okay, so here on the left side, I'll write over the text, but this becomes the expected return of the jth security minus the risk-free rate is equal to, here beta is a constant, so here it becomes beta J times expected value of the market portfolio. This is mu M minus R. And here the noise term, I think I forgot to say it, but the noise term, not only it's uncorrelated with factors, but typically it's assumed to have a mean of 0. Okay, so because of that, then this is plus 0, and this is exactly the CAPM formula. Okay, so we see that the CAPM model is a particular case of factor models when we make these assumptions here. Okay. Sorry about that. Okay, so let's pursue. Okay, so this is just the calculation I've been doing in red on the previous slide, so I won't repeat it, but we see that, oh no, this is not the calculation I did. Okay, so I did that for the particular case of CAPM, but now if we have a general factor model, then how can we predict the expected return on the stock of company J, or the expected return on security J? Then what we can do, let's go back here, we can simply take this formula and uh, take the expectation on both sides. So once again, if we take the expectation on both sides, it becomes expectation of the return on the J firm is the risk-free rate plus here. So this is the factor model. It's the intercept plus the linear combinations of loadings times factors plus the noise term. And here, once again, the risk-free rate is deterministic. It's a constant. AJ, again, it's a constant, so it goes out of the expectation. Time here, the expectation is linear. So the expectation of the linear combination of factors is the linear combination of expectation of factors. Plus here, the expectation of the noise term, we said it's always 0. So then we have the following relationship. So this is under the factor model, this is the expected value of the return of a firm J, or of security J. So in practice, well, we have a nice relationship, but how can we, in practice, what is known in this this equation? So the risk-free rate, let's assume it's something we can get from market data. Then these A's and B's, as we said earlier, if we use historical data, there are ways to estimate these values through linear regressions. Okay, so this is fine. And then the expected value of factors, well, you could look at the history of values of factors and use statistical estimation. So you just, for example, do the sample average of values of factors in the history. Or, for example, if you have factors that are well known, you might have other economics model or equilibrium models or whatever, which can allow predicting the expected value of such factors. So you can make, if you don't want to rely on statistical estimation, you can make assumptions or use other types of economic models to predict the expected values of such factors. Okay, so in that case, you would get all the quantities you need to predict the expected value of the return of a given firm. Okay, so this is great, but the factors, they still remain a bit mysterious. Okay, so what are suitable candidates for factors? So we saw that in CAPM, the single factor was the excess return on the market portfolio. Okay, so here the factor was KM minus the risk-free rate. So this is the main factor driving returns of all securities. So if the market portfolio goes down, well, typically all the securities will have a tendency to go down at the same time. Okay, but we saw that the CAPM is often inadequate in practice to represent, to characterize the expected returns of firms. So we won't survey the financial literature here. There are courses dedicated to this, but we'll remain very high level here. So what we will do in this slide is introduce a very famous extension of the CAPM model, which is known as the Fama-French three-factor model. Okay, so this is from some published paper, Fama and French, in 1992. So in this model, there are three factors which are the three main driving forces of returns on all securities. The first factor is exactly the CAPM factor, which is the return on the market portfolio minus the risk-free rate. Okay, so it still preserves the first factor of the CAPM, so we can see it as an extension of the CAPM model. Second factor in their model is called the SMB factor, and SMB stands for small minus big, and this represents the average return of small companies, or small caps means small capitalizations. Okay, so companies of smaller sizes minus that of large companies. Okay, so small minus big, it's average return of small companies over average return of all big companies. And finally, the third factor here is high minus low, which is the average return of companies with a high book to value ratio minus the average return of firms with a low book to value ratio. Okay, so what's a book to value ratio? We'll describe that in the next slide. Okay, so here these are the three factors in the Fama-French model, but next we shall describe their rationale. Okay, so why small minus big? Why high minus low? Okay, so here first, in the high minus low, this was the excess return of firms with high book to value ratio over firms with low book to value ratio. But to understand that, we have to understand what's a book to value ratio. So a book to value ratio for a given firm is the ratio of the book value of the firm over the market value of the firm. And what is the difference between both? The book value of the firm is the value of the firm in the financial statements. Okay, so the value of its assets minus the value of debt in financial statements. Conversely, the market value or market capitalizations is the traded price for the shares of the firm. Okay, so the sum of the price of each firm times the number of outstanding shares. So both quantities should not be completely disconnected, because if in your accounting statements you have a lot of assets, then you probably people who are trading your stock, they probably think you have high assets and they will pay higher price for your stock. However, there might be some disconnects, because in financial statements, accountants have a particular way to value assets. Okay, so they have rules which are sometimes rigid that they must follow to value the various assets or liabilities. Okay, so it doesn't depend necessarily on the vision of somebody, or it's just the accountant following some rules to value the various assets and liabilities. Conversely, in market capitalization, it's more a vision of how investors view the value of the firm. Okay, so for example, if you have these high-tech companies, let's say Facebook, if you look at their physical assets, it might be they might be valued very differently by an accountant who looks, let's say, at buildings or stuff like that, in comparison to the market value, which looks at further future growth potential and etc., which might be hard to estimate in practice. Okay, so this is why in practice there's a disconnect sometimes between the book value of the firm, which is value in financial statements, and the market value of the firm. Okay, so a high book to value ratio means that we consider firms for which the book value is very high in comparison to the market value. Okay, so it's firms for which, if you look at their financial statements, the assets, or the net assets, so assets minus debt, look higher in comparison to their market value. And low book to value, it's the opposite. It's firms for which the market value seems much higher than what's written in the financial statement. So this explains what is the third factor. So the average excess return of high book to value firms over low book to value firms. So the rationale for the inclusion of factors 2 and 3 in the Fama-French model is the following. So the authors, they noticed that in average, small caps tend to have larger returns than large caps. Okay, and this makes sense because small caps, they're less well established, so they're more risky. So if there's a crisis, they might be more vulnerable. So they're associated with more risk. So because of this, more risk means that investors who invest in small caps, they will expect higher returns to be compensated for the additional risk. So it makes sense that small caps tend to have higher expected returns than larger caps. So for this reason, they included this as a factor. So because it's a common driving force across the multiple stocks, they say, well, let's include this as a factor, and the various securities, they can be related to this factor. So if you're a small firm, then you'll have a different factor loading B than if you are a larger firm. Furthermore, for the third factor, the authors seem to notice that firms with a high book to value ratio tended to have higher average return than firms with lower book to value ratio. So they decided also to include this as a factor, which justifies their rationale behind their model. But of course, if you want to have a more thorough understanding on the justification of this precise Fama-French three-factor model, you can look at their paper. So there are a plethora of other factor models to explain returns or expected returns on the various securities, and this is very useful. Well, if you're an investor, you might be using these models to determine in which stocks or asset you want to invest. But I've introduced the CAPM and Fama-French because they are the most popular. So CAPM was let's say one of it was through some time the most famous model to predict expected returns of stocks because it was stemming from the by then standard mean-variance portfolio theory, but then shortfalls associated with the CAPM were identified, and the Fama-French three-factor model is a model that is somewhat dominant in the market still nowadays and is widely used to predict expected returns of stocks. So this completes the chapter. Here are the references if you're interested. Of course, again, you don't have to look at the references, but it's only if you're curious and you want to have a closer look to the theory presented here. So this completes the video for chapter 5. I'll see you next time for chapter 6.